Okay, so if you're sitting at home right now thinking about this old cash value life insurance policy that you bought years ago and you've been funding, and you're thinking, well, do I need it anymore? Maybe I don't need the death benefit, or maybe the policy just didn't work out the way that you originally thought about it, and you're thinking about just tossing it. Well, before you do that, I've got an idea that just might be better. You may already be familiar with the term 1035 exchange, where it involves exchanging one non-qualified annuity for another annuity in order to avoid taxation on the gains accumulated in the first policy. As it turns out, you can do the same thing with that old life insurance policy. You can either exchange the old life insurance policy with the gains into a new policy or into an annuity. If you truly no longer need the death benefit from your cash value life insurance, then a 1035 exchange into a life insurance policy with long-term care benefits or into an annuity may make a lot of sense for you. Here's an idea that might work, and one that might seem counterintuitive. Let's say you have an old life insurance policy with a big loss instead of a gain. If you just cash in the policy for the cash value, you realize the loss, but it's not a tax-deductible event and doesn't offset other gains that you may have. But if instead you 1035 exchange the cash value of that policy into an annuity, you get to carry over that loss into the annuity, making at least a portion of any of the future interest earned tax-free. An example, let's say you paid $5,000 per year in life insurance premiums for the last 20 years for a total of $100,000. That would be your basis. But let's assume your policy's cash surrender value is currently $75,000. That means the policy has technically lost $25,000. You could always surrender the life insurance policy and take the $75,000 in cash value and run. But if you wanted to take advantage of that $25,000 loss, you might want to consider 1035 exchanging that $75,000 of cash value into a new annuity. And because the cost basis carries over, the cost basis of the new annuity isn't $75,000, it's $100,000, even though you only paid $75,000 for that annuity. That means you'll ultimately be able to withdraw the first $25,000 of any interest earned in the future in that annuity on a tax-free basis because it's treated as a return of your basis. Of course, any insurance replacement or exchange should come with careful consideration of a variety of factors, not just taxation. If you're thinking about canceling an old life insurance policy, just give us a call and we'll be happy to help you with all that analysis.